Hi everybody, it's great to be here, and I enjoyed the last two speakers. I think it's great to see, maybe I've got to go here. Ralph from Munich Re, so traditional reinsurance company, and they're looking at ways they can change the business and adapt their business, so which is great. And then IAG, got Andrew, also a company, IAG, a strong insurance company with a strong tradition, looking at ways that they distribute product and change product. When you talk about Guy Carpenter it really looks at connecting capital from around the world to insurance. And today I'll take you through a few slides and look at it from three different perspectives. Firstly, when I look at the first insurance company in 1667, they were established around the Great Fire of London, I think it was, and their job really at that time there was funding the fire brigade to put out fires with people who had insurance losses. And it's still amazing to me today that we're still funding the fire brigade to put out losses. This time they don't have fire marks on, we're paying for everybody's losses. So it's a little bit strange still that it's taken so long, we're still doing the same thing. The policies we offer in many ways are the same as well. So I put the yin and the yang up there because you look at one side of it, and one side we want to create and change, and the other side, to do that, sometimes we may need to destroy. So we're getting pulled in two different directions in an industry which we're very comfortable in, and we've made pretty good profits. So what I'm going to talk about today, maybe first of all, is talk about the market dynamics and the state of the market, because you need to understand the market a little bit if we're going to change. Then look at alternative capital. So what alternative capital is? New capital coming into the business, which has different characteristics. And you could, in some ways, an analogy may be insurtech and different types of distributing product. It's a different sort of capital coming into the business. And then I'll throw a few ideas out there and change and uncertainty in the way that I look at the business in terms of insurance and reinsurance. And then I've got another slide, which hopefully will flick up, which is, I saw a company in Tokyo, and I'll share that with you, which is interesting what they're doing. Because sometimes you learn a lot from what goes on in other places. So the state of the market, I think when you look at the business, there's four components to it. There's the cat business, so cat loss, interest rates, capital, and results. And I'll just go through those briefly. We won't spend a lot of time on those. So the cat losses, when you look at the global market, three major losses recently. So although they're a long way away, they do impact us ultimately here as well. And then on the top of that, you probably throw the Mexican earthquake, and then you've got the bushfires in California. So there's a bunch of stuff going on. And when you throw it on a table, it's $100 billion of loss. So, and that's just the three large storms, say, and how they turn out. And you throw some other things on top of that. So in terms of result, it's sort of been since 2011 when we had the earthquake here, and we had the tsunami. It's taken a long time to get up to these sort of level of losses. So it's quite significant. So when you look at capital coming into the industry, they'll be thinking twice in terms of what they want to do in terms of delivering results. And if you put it in terms of economic loss, they're pretty big. Katrina, you may recall, the big storm in the US, and you've got Harvey next to that, the recent one. So in terms of economic loss, it's pretty significant. So the difference between the insured loss and the economic loss is what's retained by the government or uninsured properties. So these losses are quite significant. If we look at interest rates aren't looking too good. This is the 10-year government bond. In insurance business, if you can't make money writing the insurance business because the losses are too high, so your loss ratios, you can offset it with interest rates. And interest rates aren't looking that good, so they're around about 2%. So if you bring it together, this is a table, and along the top you've got investment yield. So this is if you invest some money, you get 2%. So I'm linking it back to the government bond yield, around about 2%. And then on the table on the left-hand side, or vertical, at the ROE, that's the return on equity. So if you want to invest in a business these days, and I think if you go back a little way, there's a debate about what is a good return on equity when you invest in something. Probably it was more like 14%. I think today, if it's a single-digit return on equity, I think it's a pretty good result. But if you want a single-digit 8% return on equity, and what I've circled there, the 93, in insurance, that's the combined ratio. So combined ratio is basically if you add up all your losses and your expenses and you divide it, you come to a percentage. We want it below 100. So if the 93 means you've got 7% of profit sitting in there. So if you want to if you've got a 2% yield and you want an 8% return on equity, you back it into your business that you write, you will need to achieve a 93% combined ratio. So that's the business of doing insurance. And so that's the market we're in. If the yields go up, of course the combined ratios go down. And if you go out to the right, you used to be able to, when there's 8% yield, you could write the business at 108%. So you could lose business on selling insurance and you'd still make money. But with lower investment yields, you can't do that. So when the global market looks at where they put money in, they look at these things in terms of the return on their investment. So that's changed with the market dynamics. And interest rates probably aren't going anywhere too fast. Capital. Is the capital interested in the insurance business? Well, I just talked about yields there a minute ago, and I'll come back to that. But you can see the amount of capital in the market's growing. So the light blue at the top is new capital. So what's new capital? New capital is, I'll come back to it in a minute actually. The new capital is a slide on it, but new capital is like pension funds. New capital is hedge funds looking at, I can get a pretty good return on insurance, so why don't I go to insurance? If I invest in fixed interest, I'm getting 2%, maybe I can get 4, 5, 6% out of insurance. So the amount of capital available in insurance is increasing, and it's a demand-supply thing. So the more supply, typically the lower the price. So the amount of capital increasing puts pressure on pricing. If we look at the results in terms of this slide here, the two things I'd look at, one is there's the dark blue in the middle, there's a sort of a lighter blue color there. That's looking at the underwriting results for the industry. And the underwriting results you can see are reducing, so the size is really reduced down quite significantly from 15 to 16. So when I talked about running good underwriting results, this isn't necessarily happening. And that's 16, and Ralph will say in a minute, look at 2017, because I talked about the storms, that will probably get worse. The other interesting thing is the purple box on the top, that's reserve releases. So releasing prior year reserves to prop up current year results. So that's been going on as well. And if we dig into that a little bit more, we look here at the P&C premiums. The premiums are increasing. This is global premium, so which makes sense because the economies grow. It will naturally grow. Also new developing economies in there. Not increasing at a dramatic rate, but increasing. If we look at gross premiums year-on-year change and we start looking at different companies, you can see some companies are growing more than others. Part of the reason there is if you can't really grow your business, you start merging and acquiring. So on the left-hand side here, probably got a pointer, is you've got XL Group, acquired another big company. Linghi is an Italian investment fund who purchased PartnerRe. The interesting thing here is some of these names coming up too are not traditional insurance or reinsurance companies. It's other funds or investors going, I quite like insurance, I'm going to start buying reinsurance companies and insurance companies. So capital coming down the chain to actually start owning some of these businesses. If we look at the combined ratio, so this I talked before about having a combined ratio, and I put a 93 with a red line there. The last few years have been pretty good. The industry has actually achieved what it needed to achieve with the lower interest environment. And you can just see the last year it's creeped up. In 2017, it'll probably creep up more like 2011. So 2011, the earthquakes in New Zealand, pretty bad year for the industry. So no surprise there, lots of losses, bad year, and then the last few years, the industry's been able to recoup a lot of their losses. 2017, I can imagine that'll be a similar line going up in 2017, which is the nature of the business. When you write these large programs, it's the nature of the business. The benefit for New Zealand, of course, is if you use overseas reinsurers, you get the benefit of funds coming in following a loss. Japanese apply the same principle. You use the global capital market to smooth out what is a very difficult period of time, and the reinsurance companies have the ability to spread that and make money in the good years. They just need to make sure there's enough good years to pay for these very bad ones. And if you look at the breakdown of, this is the combined ratio, and I've just put it into components now. So you've got 33.6%, which is the one on the left. That's the expense ratio, and then you've got the loss ratio in the dark blue line there. My guess is, and the reason I put that up and just put that slide, which for looking at, is My guess is when you look at competition coming into the market, they'll be attacking that expense ratio component. It's how do you get product to customers at a cheaper, faster way is probably where we're going. So the losses are probably going to be the losses. In a lot of ways, it's the expense ratio where you can create your margin. And that's all things being assumed that pricing doesn't change dramatically. The other way where you get your results, this is reserve releases. And these little dotted lines up the top there are reserve releases. So a bunch of companies along the bottom, you can see they've achieved their results by releasing prior year numbers. So it means they, in the current year, so the one on the left here, this Renaissance, it has a 75% combined ratio. If it didn't have reserve releases, it would have been a lot higher. It would have been lower if it didn't have reserve releases. And then on the right-hand side, you can see reserve increases, which is the unfavorable reserve increases on the right-hand side here. The reason why I put that up is it's interesting that the long-tail market, and New Zealand isn't impacted so much for that, but it tends to go in cycles of reserves going up and reserves coming down, and it depends on the claim environment. So if you have reserves going up, so there's more money having to be put in, and you have unfavorable cat losses in the market, it puts a lot of pressure on getting returns inside the industry. But you change in shareholder equity, you can see that that's been pretty good. Money, the profitability years, they've been putting money back into the industry, so the capital of the industry is pretty strong. And then return on equity, that's the Carpenter reinsurance, just looking at it, that's been pretty good too. So the return on equity, the red line there I've put as 9%. It tracks above 9% pretty well across those years. And you can just see as the soft market, really the last year, 16 and 17 won't be good either. The ROE have started to drop down below. And I think of the finance people in terms of what's an expected ROE for the business, it's probably single figure, I think, these days in terms of the business. And if we bring these together, this is we put the global loss index against the losses here. So insured losses are the blue bars, and then you get the rate on line index. So this is how do the rates change following events. So you can see that in 5 and in 11 and probably in 17, the bar ticks up. So losses occur and prices generally go up. But if you look at it again, and this time I overlay the 4 different regions here, we track it regionally, you can see that in 2011, so the dark blue bar being the UK, nothing's happened to their prices. So they didn't help us out when we had our losses down here. But when you look at the Asian one, which is the light blue one, you can see that, or the Asian one, the green one, sorry, you can see that following the 2011 losses, prices go up. So you're sort of seeing cycles within cycles inside the business, which makes sense. Where losses occur, rates tend to have gone up. So this is just historically how the market works. And then this one here is just this is M&A. So businesses are getting bigger and they're combining to become bigger organizations. So bigger organizations, you get the point of it's you get more productivity, you get economies of scale, and you get a lot of things by becoming bigger organizations. And so that's what's happening really in the world of insurance and reinsurance. These insurance companies are becoming bigger. And what normally happens, I guess, when that occurs, it opens the door for smaller organizations potentially to come in and make some difference. Because bigger organizations can be quite hard to change. And this just brings it all together. The point here is really the reinsurance market, just in terms of the capital in the business, there's a lot of capital around to support the insurance and reinsurance business. And I think that the question will be around price and exposure management on a go-forward basis. This leads to alternative capital. So if the industry's been making quite good returns the last few years, if you look at cat bonds, and that's alternative capital, the point of the slide here is the corporate bond versus a cat bond. So if you invest in a cat bond, which is a bond for catastrophic insurance or reinsurance. So an example of a cat bond is I could sell a cat bond to the New Zealand government that if an earthquake occurred in Wellington was greater than Macquarie 7, I'd pay them $100 million. And they'd pay me a premium in return for that. So it's a trigger. It is a parametric type trigger. If this occurs, this occurs. So it's a bond style thing. These are quite attractive because the returns the insurance company are getting on these are higher than if they invested in a bond or corporate bond. The only difference is that you could lose the full amount. So you would expect some higher. So this market has been growing. And the dark blue sort of shows the size of the capital. And if we go through it, this talks about the growth of the business. This one here, we talk about the different types of cat bonds. So cat bonds at the top, collateralized re is just another form of this capital accessing the reinsurance business. So there's different vehicles here that do that. And then starting to look at the change in the capital and the risk capital value chain here. On the left-hand side, you've got us with a house, or me with a house. I use Marsh and I buy some insurance, and I got a few American reinsurance companies in there, but it could be anybody from any insurance company, IG or Suncorp. Guy Carpenter is a broker, and we sit in between the insurance companies and the reinsurance companies, and then the reinsurance companies pass that risk off to capital markets particularly. So in terms of the chain of risk capital, where your house insurance policy goes, it actually goes along this chain to some degree or other. So when you have a Christchurch earthquake, on the right-hand side is where a lot of the money comes from. So it comes from reinsurance companies, and behind reinsurance companies, there's capital. So this is the value chain. And what we're seeing really is the guys on the right-hand side, or your left-hand side, right-hand side as you look at it, are trying to connect with the house owners. So how do they do that? And the last couple of speakers talked about insurance and insurtech. Can you connect the capital on one side of the house to the insurers on the other side of the house? And wouldn't that be nice? Because everybody in the middle, including Ralph and myself, would be playing golf, and these guys would be connecting. So when you buy a house insurance policy, it wouldn't be Suncorp or IAG. It may be something on the right-hand side, called Securus. And would you do that? I don't know. But Securus might be the capital backing a distribution channel to give you insurance. And this is the discussion that goes on in terms of in the insurance circles. So the changing world, if we look at it, and when each of the companies, and including Guy Carpenter, when we discuss it, we talk about, is this value chain going to continue on, or is this value chain broken? And the guys on the right reckon they can provide house insurance policies to the people on the left, which in theory is potentially there. Where does that money come from? It's pension funds. So this money here, the guys on the right, are pension funds. So it's the money that we give to, I think probably Kiwi Bank here, or where pensions are held here. They want to invest that money to get a return. So they invest that into the insurance business because the returns are better. So potentially, your house would be insured by Kiwi Bank, I guess, or Kiwi Bank would have an element of that risk. So when we talk about capital, we're talking about these capital providers coming closer and closer to the business. The reason why they'd invest in insurance is we talked about a higher return. So as long as they can get a higher return, they'll potentially put a portion of their investments into the insurance business. And that's called diversification. So you have a diversified investment portfolio. Insurance would be part of that diversified portfolio, transport maybe another, and so on and so forth. And then along the bottom here, you've got a whole bunch of other, sort of money managers, etc., hedge funds who are also all putting money into the insurance business. And at the moment, it goes along the value chain, but they're talking about how can they cut that value chain. And this guy we all know, Warren Buffett, we would like to get into the commercial insurance business very big time. So Warren Buffett, you talk about capital hitting insurance. That's so far away from it. He runs railway companies. But he's talking about how does he get his capital directly into insurance. He started the game writing large, big cat risks and writing reinsurance and insurance. But you can see he's looking at the insurance game. So how do I get my capital down that value chain to people? And up the top here, we've got the excess capital, we've got the intermediaries, and we've got the capital markets. And he's done a few things already. So in the area here with IAG, he's put a 20% quota share into the business. So what does that mean? So that means 20% of IAG's risk is going through to Berkshire Hathaway. So it's a win-win for the two companies. So IAG gets capital. It frees up capital from a Berkshire Hathaway taking 20% of the risk. It enables them to free that capital up and invest in other things. For Berkshire Hathaway, it gets them directly into the insurance game with a credible insurance partner. On the maybe the one not so familiar with everybody, but the Gen Re, Trans Re. So Gen Re is a reinsurance company, and Trans Re is a reinsurance company. So you've got two reinsurance companies here now, and one reinsurance company, this company Gen Re, says to Trans Re, "You go and write all the business, and I'll just give you the pen. Away you go." So you got a reinsurance company giving another reinsurance company the pen to go and write a whole lot of business, growing the business. So that's sort of happening as well, where they say, we can't get into that particular area of the market, so why don't you do it? And you've got Berkshire Hathaway Specialties here, but you can see that there's this, if Berkshire Hathaway is doing that, then other companies are going to be doing that too, or thinking about doing that. And I could run some other names off who you may not recognize, but potentially there are a bunch of names that would actually do that. And the reinsurance companies have looked at insurance as well. So the reinsurance companies have sort of stepped back and looked a bit here and gone, what's going on with insurance? So you can see the value chain getting blurred up a little bit, and what I haven't put on here probably is insurance companies buying reinsurance companies, and that's going on too. So the whole value chain that I spoke about is getting a little bit blurred around the middle, if it's not getting blurred on both ends. Why is that? Probably because of this. So this morning, I'll put three words on it when I look at a insurance business. So I think there's three components to an insurance business. There's manufacture, distribution, and capital. So distribution, I think Andrew talked a bit about that. So distribution is the way of delivering from me to the risk taker. Manufacture, I call claims, I call underwriting, how you come to the price and do the business of doing the business. And Andrew talked about that the IAG brand is quite good because if you've got the information and data, you can plug into the insurance company and they do all the manufacturing. They tell you what the price would be, they tell you where you should write your business. And then capital, I've just talked about capital. So capital can come from anywhere. So there's a lot of capital, and the capital enables you to take on risk. So I think there's three components to an insurance company. So if you look at a typical insurance company, the manufacturer, distribution, and capital to some degree are all within inside the company. So all components. So traditional insurance companies have very big balance sheets. So they take on risk, they underwrite it, and they distribute it through their channel, and they bring it back in, and they make a profit. So that's the way. And the question really is, are each of these components necessarily linked or not? And when we talk about InsurTech, in my summary with InsurTech, it's about distribution. So it's not the manufacturer, it's distribution. It's distributing and plugging into somebody that gives you the manufacturer and the capital. So as we think through that, if we look through those, manufacturer understanding risk. So this is it's a Guy Carpenter tool which you look at. So we can go through and look at an individual risk here without even visiting the risk. So I can call up Tim and say, Tim, I'm going to insure your house tomorrow for $500. How do you know that? Well, I know it's a 4-bedroom house. I know where you live and I know what it looks like. It's $400, and I know your elevation above sea level is 500 meters and so on and so forth. So I know all the characteristics, so I don't even need to visit the property. So in terms of manufacturing, understanding risk, it's becoming a little bit more of a level playing field. So the data mining aspect is there, but it's a changing game. The unintended consequence of this, just as I heard the panel chatting here a little while ago, is it means that I pay more for my insurance premium than you. If my risk is a worse risk than your risk, I pay more money. So in Queensland, if you're on the coast in Queensland, your insurance policy is thousands of dollars. And if I'm inland a little bit, it's hundreds of dollars. So with understanding of risk comes a cultural society aspect of, are we willing to cross-subsidize? Ralph touched on that in the presentation. That's a bigger aspect. So when you talk about unintended consequences, with technology brings a greater clarity. And it was the red car, was it the red car, white car thing? You know, if you have a red car, white car, different premiums. Does the regulator stop that? So in America, flood is a problem there. So they created the flood pool in the United States. It's now, I don't know if you know, well, $15 trillion in debt, because it is cross-subsidizing a business which is not profitable. So with this technology comes understanding risk. So you can actually now pinpoint it. So that's the unintended consequences. So as a society, are we willing to cross-subsidize one another? And I don't know whether we are. And certainly in Australia at the moment, I don't know whether we are. And it comes to the affordability issue, which I know the insurance councils talked about several times in terms of affordability and how do you do that. We've done that historically by cross-subsidization. We now start to know who's good risks and who are bad risks. And we're starting to transform complexity and understanding where we want to write business. So there's a lot of complex outputs, and I think one of the things that these big data companies do, and there's a bunch of them around there, they take a lot of data, they bring it all together, and start to pinpoint what it is, these characteristics, which are good risks and bad risks. And you can see this, and the driverless car was mentioned earlier too. What's the impact of the driverless car? Interesting at the moment, I think, I'm not an expert on the motor insurance, but motor insurance is going up because the technology costs, is my understanding. So there's an interim problem of technology to repair your car is more expensive than, I don't know, fixing up the radiator or the brake pad. So that's changing. Future development, so this is lowering barriers to entry. So technology will lower the barrier to entry. So if I can go and get someone to give me some capital, so I'll go and see Warren Buffett, he gives me some capital, I can use technology to understand good risks from bad risks. It means that I can get into the industry pretty quickly as long as I can find someone that can distribute it. So the manufacturing component, can I decompartmentalize that? So I go and get my claims managed over here by somebody, I get the underwriting done over here by some analytics guys, and over here I get my risks guys. So can you actually break it up and do it? The question for insurance companies I throw out there is, would you sell that service to me? So would you, as an insurance company, sell me your claims management service? And the answer is yes, it will happen. That has happened, and I've seen it. So insurance companies would sell their service and claims management. Maybe not to everybody, but it is possible. So it's manufacturing, can you break that up and do that? So the problem I'd have with getting the capital in, I've got the distribution, how do I get this manufacturing component done? And Andrew made a good point earlier in terms of brand. What does that mean in terms of brand? If I'm Securus, do you trust me? Maybe not. So how do I get that brand covered as well? This one just talks about moving around the chain in terms of knowledge of the business, so I won't spend much time on that. In terms of people that can provide data for me, in terms of good risks from bad risks, there's lots of them now. Used to be 3. There's loads. So in terms of understanding risk, I've got someone who can provide that to me now, independently. Still got the claims problem, I've still got maybe the accounting problem, but I've certainly got this done. And look at these guys. Amazon. You know, where could competition come from? It's potentially from companies like Amazon, 4% of insurance. So they're a distribution platform. So they're missing the other 2 components, manufacture and capital. Capital is probably relatively easy, manufacturer. So once they nail that manufacturer component out, you could see these sort of companies and all of these coming down. And I guess if I asked many of you, you could probably double the size of that. Because a lot, it's interesting. My son's at university, and he's just finishing up, and he's tried to set up his own internet company selling socks, I think it was. So it's pretty easy to get into the space. If you're selling socks, could you sell insurance? So that's if I look at it, the components of how it's going to happen. And this is a great little thing in terms of it's going to happen if I look at it. So new entrants, lower cost of capital. So if their expenses are lower, so I talked about the capital costs in the typical insurance companies, 30%, 36%. These capital costs are a lot lower. Their expenses, they're a more aggressive investment strategy. So rather than bonds, they're looking at a slightly more aggressive investment strategy. Lower expenses, I just mentioned. a requirement for underwriting profit. Do they necessarily need an underwriting profit? Depends a little bit, once again, on that investment capital equation. But if lower expenses, it makes a big difference. And here's a company doing it. I thought Ralph would like this. Munich's in the red. So this is a company. It's available. I just pulled it off the website. That's why they're a bit ropey, the slides. Just go back one more, sorry. Just go back. The green and the red are, it's a quota share. So the bottom blue bit is what this insurance company is actually retaining. The rest of it is ceded off to reinsurance companies or capital markets. So they retain about 25% of their business. On the right-hand side is their expense ratio, which is 15% below the market. 15% below the market. And there's more to the story in terms of what they're doing. And then the bottom, of course, is their share price. Pretty excited to own that company. So it's just an example of I would just say, a capital light business. So if you have a quota share in place and you hand that risk over to the reinsurance company, you don't need the capital associated with it either. So it's a capital light business, which means a lot of other things too. So it's just an example. And then what is in Japan, you can flick this next slide up. And the reason why, this is just their web page, I think. So we can go to that. Or do I just push this? No. Go back. Might come in a second. There we go. So this one here, this is really interesting. I was in Tokyo just yesterday, and I met these guys. So Rakuten, it's called, and it's Amazon. It's sort of a Google, Amazon in Japan, and the Japanese characters up here. And they've got this. I just thought this is their company culture, and you can go to the website and look at them anyway. But the guy who set this company up wasn't that long ago. He set it up. It's grown enormously. He's in the insurance space. And if you just look at and you can scroll up because we can't read the thing. So this is the company philosophy. It's got always improve, always advance. And if you just keep scrolling up in a minute, it's quite interesting. Some of these are sort of nice sort of statements. And we just keep going. The last one is interesting, I think, because it speed. And you go there, and the guy wants solutions right now and here. It is fascinating. And their insurance, what they're putting insurance product out is in Japan is an agency-based market. So I'll throw another layer of distribution on there. It's agency-based, so it's not brokers, and we all sit in behind. And he's breaking it with this product, and what he's delivering in there, and the offices, probably like a lot of these offices light and all that. But he's really, really focused on this. And a lot of it too, a couple of points earlier, is that it's very focused on what the customer wants. And has been very successful in delivering that. So just to wrap up, the last one here is it's capital distribution and manufacturing. And I think the challenge for us really is, are we able to change our businesses? It's very tricky to destroy and rebuild a business. Very tricky to do that. It's easier to be a new entrant coming in. So with inside organizations, it's great to see organizations changing and looking forward, but it's very hard to do that when you've got the results going through. So if I look at the business as a general thing, capital distribution and manufacturing, I think these are the three areas when we look at business going forward, what we need to understand and where we're providing value in that value change. So the change going forward, I think, will be around these three. They're around these three. And I think manufacturing is the area at the moment where nobody can do manufacturing. Distribution's been changed, so we need to be careful about what that manufacturing is. And do we sell that manufacturing to other insurance companies is a question I'd put out there. I think it may change. Thank you. Thank you for your time.
Thanks, Tony. It was a fascinating presentation. I love the speed, because I've always been a huge fan of sense of urgency, which is not always something that we find prevalent in many businesses. A couple of questions that have come in on the feed. Do you have any loss forecasts? Does global warming change the forecasting by much? And how does the US withdrawing from the Paris Agreement impact the forecasting?
Yeah, I think the climate change, how that affects our industry, is it's going to bring to light that we're building probably in places we shouldn't build. So if we roll that forward, it's going to be areas where we have built and we are going to have bigger losses. So naturally, there's going to be an increased number of losses because with the climate change and potentially the storms becoming more severe, they may be more severe, but they're hitting places where we didn't used to live. We're populating. We like to live on the coast. You know, we don't like to live inland.
Yeah.
And on the coast is where the storms are going. And we like to live on the coast, and we like to build really big houses on the coast as well.
So the reality is that coastal properties are going to face significant hikes in premiums.
Significant hikes, and that's happening in Queensland. And then it's an affordability issue. And then you get down to it is, if you've got a big fat house on the beach, I'm not paying for it. That's your problem. So when I look at that, and in terms of the industry, you know, working with climate change, I see a lot of companies doing that around education and what it means to the business. I think that in terms of the business, it's educating people about the risks they have and how they can sort of manage for those risks.
Second question, have cat disasters become more frequent, or have they merely become more costly to insurers and reinsurers?
Seems to be a bit of both, I think. You know, the hurricane season, I think it's been almost a decade since we've seen this sort of activity. So there is a little bit of cycles within this business. So being more costly, absolutely, and I think that will just continue to increase.
And is it correct to say that the insurance industry, that the insurance industry should start factoring in a major cat event approximately every 4 to 5 years and devise strategies accordingly?
I think so. You need to stress test your business to be able to withstand these cat events. So that means that the way you structure your capital within the business may change. So as companies have expanded, sometimes you get into a position, I think, in many ways, where there's a component of your business that you may not like anymore. So can you take this component out and pass it off to a capital provider or a reinsurer? And I think the answer is yes. And so if you have too much risk in one area, the answer is probably yes. And in terms of I suppose the loop on that question is we do have models. The models are a way of technically trying to assess what the right outcome is for an event. It doesn't mean they're accurate. The bushfire storms in California at the moment, and I didn't put the range up there because it's between $3 and $8 billion. So one modelling company says it's 3, the other one says it's 8. Who's right and who's wrong? And I think after every event, the modelling companies will put these out. So understanding the capital, how it responds to a risk, are things which are changing, and I think that companies need to look beyond that.
Great. Ladies and gentlemen, Tony Gallagher, thanks very much.
Thanks.